Have you ever sit there and wondered what depreciation is? Accounting jargon can be ugh. Follow my video and I'll break it down into layman's terms. Hi, I'm Michael from MDH Accountancy. Click subscribe to get all of our business tips and tricks. Accounting jargon could drive any small business owner absolutely mad. So depreciation comes up a lot when we're talking with our clients. So I want to take this video to understand what it is, why it's in the accounts, put it into layman's terms to help you understand. So in your balance sheet, which is a picture of all your assets and all your liabilities, we have certain assets that are called fixed assets. Now, fixed assets can be office equipment, it can be cars, it can be computer equipment, anything that's going to be a significant value that's going to last more than 1 year. What we do is we capitalise them in your business straight away. Let's just say it's a laptop and you've spent 1,500 quid on a laptop. That will go in as an asset of the business, and over its useful life, which means when it becomes really slow or you've got to have it plugged in all the time before the battery is completely knackered, and then it's worth not a lot of money. So we tend to do computer equipment over 3 years. Yes, you can argue 4 years, and some of my old employers can argue 9 too. MDH here, we normally do it over 3 years, and we normally basically cut it so in 3 equal slices, so them costs go into the profit and loss account. So what you're doing is you've got an asset that starts off at £1,500. We then take off in year one £500, which then makes the net book value what is deemed to be worth £1,000. Next year we take off then another £500, and then we take off another £500 until the value is sitting there at 0. When we're taking off them amounts from the asset, they're going into the profit and loss account as a cost. Because if we put the asset in year one, it would make the expenses a lot higher instead of spreading it out over its useful life. So each of the £500 is going to go into the cost into the profit and loss account, and that will reduce the profit for the next 3 years, which is the life that we deem a laptop is usable. Again, companies can do 4 or 5. There's no hard and fast rule on this. It's down to the judgment as you, the director. Now, I fully understand that most people will take advice from their accountant, and that's fair enough. We have our standards that we use. It doesn't mean whether it's right. Now, from a tax point of view, this is where it can sometimes get a little bit confusing for an asset. When you buy an asset, it goes straight into off your profit in year one, and you get all of it 100% in year one most of the time. An exclusion for this can be cars. But when you're in years 2, 3 and 4, because you've had it all 100% in the first year, you don't get it again. So make sure when you're actually reviewing your accounts that you go in the year one, that you celebrate the win of getting the tax relief in year one. But when you've got depreciation coming as with the laptop in years 2 and 3, that would be added back for tax purposes. So make sure with depreciation, which is an accounting entry, you're not getting this confused with the tax treatment of it, because it's done slightly differently if you're a UK limited company. I hope this video has helped you, but if you've got any questions that we can help at all, click our calendar link below. This will allow you to book an appointment in our diary, and we'll take on board any questions that you have, and we promise there'll be no pushy sales pitch. Have you considered how much you're saving in tax? We've got a book that's called 70 plus ways to pay less tax, and they're all good. How many of these are you taking the opportunity of and saving tax within your business completely legitimately? Download a copy today for free on us.